Welcome to the Teaching You to Fish podcast, financial literacy for the rest of us. My name is Carl Fish, and I'm the host of this podcast. This is episode 8, Debt. Credit is one of the greatest financial inventions of all time. It's a foundational piece of our quasi-capitalistic system. Without credit, the growth of the world would have been much slower, and the prosperity of the world would be much lower. Credit allows new businesses to leverage debt in order to get started, to take risks, and to eventually grow and return a profit. This helps introduce new innovations and services into the market, as well as grow the economy and build wealth. Credit can also be an important and very useful part of an individual's financial life, but it's also an area where many people end up in trouble. As we discussed in episodes 3 and 4, it's easy to live beyond your means and get into too much debt instead of saving and investing. So in this episode, we'll talk a bit about debt and the danger it poses. First, a quick definition. Debt is any money that you owe to someone else, whether that be a person or a company. This includes formal loans, credit cards, and anything you've bought but haven't paid for yet. Really, you should think of all of these as just debt. Debt can be useful when there's something you need, emphasis on need, but don't have the necessary means to pay for it entirely up front. This often leads to a discussion of good debt versus bad debt. I'm not a huge fan of the term good debt because, to me, any debt, for individuals as opposed to companies, is by definition a negative thing. I prefer the term strategic debt over good debt. But no matter what you call it, let's try to define it. Good or strategic debt is generally defined as taking out a loan on an appreciating asset, something that will increase in value over time. Bad debt is taking out a loan to buy anything else that is not an appreciating asset. So let's take a look at 4 different examples of debt, try to classify them as being strategic or bad, and get into some of the nuances of each one. The first loan that many people take on is a student loan. A student loan is often classified as strategic debt. It's considered strategic because it allows you to get an education that, theoretically at least, will translate into higher future earnings. Those higher future earnings are the appreciating asset that can make getting student loans a good decision. But, as is almost always the case, the details matter, and there are some important nuances here. First, while student loans can be strategic debt, if you can figure out a way to avoid them altogether, or get a smaller amount, that's a much better option. Some ways to do that include taking advanced placement and/or concurrent enrollment courses in high school, so you get college credit for little or no cost, choosing a less expensive, more affordable college or other post-secondary choice, trying to get as many grants or scholarships as possible, working while in high school or college, or finding roles on campus like being a resident assistant that can offset some of the costs. Optimizing your class schedule and class load so that you graduate in the shortest amount of time possible, while still getting the education you need. And, of course, if your parents have planned ahead and have been able to save up for your post-secondary education through things like a 529 college savings plan, which we'll talk more about in a future episode, that can make a huge difference. But if you still find yourself needing student loans to make up the difference, and that's the only way to fund your higher education, it can certainly make sense to get them. But even then, you need to be realistic. And part of that realism is factoring in your future potential earnings and sizing your student loans appropriately. A pretty good guideline is to not take out any more in student loans, total, than you expect to make your first year out of post-secondary education in the profession you are getting the education for. So, for example, if the average starting salary in the career you're getting the education for is $50,000, the absolute most in student loans you would want to take out is $50,000. And, to be perfectly clear, just because this is the most you can take out doesn't mean you want to take out that much. You should try to take out the absolute minimum you need. Unfortunately, millions of students and their parents have been seduced by the idea that student loans are strategic debt, so they've taken out way too much in loans and are now regretting that choice. Don't be that person. If the institution you'd like to go to would require you to take out too much in student loans, choose a different institution that is less expensive. Or wait a few years, and work and save up in order to get that education without taking on too much in student loans. The second type of debt that people think of as strategic is taking out a loan to purchase a house. Obviously, if you choose to buy a house, the vast majority of folks will have to take out a mortgage. As we discussed in episode 4, if owning a home is part of the life you want to live, then that could be a good loan to get. But as we discussed, try to right-size your home the first time, as the transaction and other costs associated with moving up to a new house are very high. You also need to be realistic about how much home you can truly afford. As always, it depends on your individual circumstances, but in general, you don't want to pay over 30% of your gross income on housing, whether that be for rent or for a mortgage. That means, for example, that if you, and your partner if you have one, have a gross monthly income of $8,000, the maximum you'd want to spend on a house payment is $2,400 a month. And this includes not only the principal and interest on the mortgage, but also homeowners insurance and property taxes. Like all guidelines, there can be exceptions. Perhaps you stretch a bit more if interest rates are particularly attractive, or if you are very confident that your income will increase substantially very soon. And, as we discussed in episode 4, if interest rates drop significantly after you purchase, typically by 1% or more, you definitely should take the time and make the effort to refinance at that lower interest rate. One of the advantages of home ownership is that it locks in the majority of your housing costs, as your principal and interest payment is locked in with a fixed rate mortgage, and only your insurance and taxes are subject to inflation. The lower you can get that mortgage rate, the better. A third type of debt that is common is a car loan. A car loan definitely doesn't qualify as strategic debt, but many people try to create a third category that they might call necessary debt. Their rationale is that, well, I have to own a car to get to my work and earn an income, so therefore a car loan is necessary. You probably won't be surprised that I'm going to push back a bit on that. First, as we discussed in episode 4, some people, in some locations, don't need a car at all. They can instead use public transportation, or walk, or bike to work, and simply rent a car when they want to go on a road trip. But, assuming you do need a car for daily transportation, there are generally two scenarios that you'll find yourself in as you become an adult, starting off with privilege or without it. Some of you watching this started off, or will start off, your adult lives with a huge advantage, which I'll generally call privilege. You grew up in a home with parents who earned a decent income and were financially secure. It is fairly common in these households that when their children become teenagers, their parents secure a car for them to drive around. This is often a used car purchased specifically for this purpose, or the parents get a new-to-them vehicle and the teenager gets the existing, older family car. What then often happens is that when you move out, your parents give you the car you've been driving. In this particular scenario, I'm going to suggest that you should never, ever need a car loan, unless you're extremely unlucky and your gifted car fails in the first couple of years you're on your own. As we discussed in episode 5, if you own a car, then car expenses, including repairs, insurance, and then eventually replacing that car with a new-to-you car, are not an emergency. They are expected expenses. And those expenses need to be accounted for in your budget and cash flow. If they aren't, then you are living beyond your means. So if you are given a car from your parents, and you start off without a car loan, then you should be setting aside money not only to maintain it, but then to eventually replace it when the time comes. If you do that, then when it's time for a new-to-you vehicle, you should be able to pay for it without taking out a car loan, ever. Or, in the worst case scenario, you may have to take out a very small car loan to bridge the difference, but then you should work really hard at paying it off as quickly as possible. But not everyone comes from a family of privilege, and therefore not everyone is given a car as they become an adult. In this scenario, you very likely will need to get a car loan for your first car. As we discussed in episode 4, while this is a new-to-you car, it likely shouldn't be a new car, but a reliable, economical used car. The lower purchase price will not only make it more affordable up front, which will mean a smaller car loan, but will also cost less for insurance and registration, which will then help you pay off your loan faster. After you pay off that first car loan, you should keep making those car payments, but make them to yourself. You should set aside those car payments you had been making to pay for future repairs and maintenance on your newly paid off car, and then eventually to have enough saved up for when you need to replace that car. By continuing to make car payments to yourself, you will ensure that you will never need another car loan after that first one. There's also one more consideration when discussing car loans, which is how often you replace your car. The good news is that cars are much better made than they used to be, so they last much longer. And this is particularly true if you take steps to reduce the number of miles you drive. And the even better news is that as we make the transition to EVs, this becomes even more true. EVs have a much lower cost of ownership and should last even longer than gas vehicles because they have fewer parts and, crucially, fewer moving parts. For any newer vehicle purchased today, and especially if it's an EV, it's not unrealistic to expect it to last for at least 20 years, as long as you maintain it, and especially if you limit the number of miles you drive by shortening your commute, carpooling, occasionally biking or taking public transportation, and just generally trying to make fewer trips and driving less. While most Americans replace their cars much more frequently than that, that's increasingly a choice, not a necessity. I'm 61 and own an EV, and I'm reasonably hopeful this is the last car I'll own. Barring an accident or some kind of major damage to it, it should easily last the 20 to 30 years of driving we have left. There's always the possibility there'll be some amazing advance in vehicles that will make it worthwhile to buy another one, but I'm guessing there's a greater than 50% chance we've purchased our last vehicle. So, if you do the math, then most people will only need to buy 3 to 4 new-to-them vehicles throughout their adult life. So if you grew up with privilege and can avoid that first car loan, or if you didn't and can avoid every car loan after the first one, you've set yourself up to achieve financial stability and eventually financial independence much, much earlier. The last type of debt I want to talk about is other, which generally means credit card debt. Unlike student loans or a house or a car, this is just buying stuff. And while some of that stuff, like food, are necessities, quite a lot of it is discretionary. As we discussed in episodes 3 and 4, you need to make spending decisions in a realistic manner and make sure you aren't trying to live a lifestyle that you can't truly afford, or at least can't afford yet. If you live beyond your means, if you get on that hedonic treadmill and succumb to lifestyle creep, you may find yourself using credit cards to fill the gap between your income and your spending. This is clearly, undeniably, bad debt. Used well, credit cards can be a valuable way to not only track and manage your spending, but to actually increase your savings through rewards. We'll talk about this more in our next episode. But used poorly, they are an existential threat to your financial security. You know yourself better than anyone, so figure out whether you can be the type of person that uses them well or not. If not, then it's probably best not to use them. It's still good to have one for emergencies, and only use cash, checks, and debit cards. If you do use one or more credit cards, set them up so that the full balance is paid automatically from your spending account each month, no matter what. If you don't think you can commit to doing that, if you aren't sure that you'll be able to have your credit card bills paid in full automatically each month, then you shouldn't use them. So let's take a look at what using credit cards can cost you if you don't use them responsibly. Later in this series, we are going to look at the incredible opportunity that compound interest provides you when you invest money. But right now, we're going to look at the incredible danger compound interest poses for you if you take on debt, particularly bad credit card debt. We are going to look at what your credit card balance is costing you if you just make the minimum payments required each month, as well as what an item could cost you if you buy it with credit. Open this Google spreadsheet by typing in the link or clicking on the link in the slides. It will ask you to make a copy so that you have an editable version. Click Make a Copy. This spreadsheet gives you the ability to enter up to 5 credit cards that you are carrying a balance on, including the respective interest rates, and will illustrate how long it will take you to pay off your balance and how much you will pay if you make the minimum payment, or if you make an alternate payment amount that you enter yourself. You can also use it in the same way for an individual purchase amount. Note that for some balances, interest rates, and payment amounts, you will not pay it off within 10 years, which is all the spreadsheet goes to. All the examples assume you do not charge anything else to the credit card going forward. In cell C1, put your first credit card balance that you are carrying. In cell C2, put the interest rate for that credit card. In cell C3, enter a payment amount only if you want to see what happens if you make a payment larger than the minimum payment amount. Leave it at 0 to see what happens if you just make the minimum payment. Cell C4 then shows the total amount you will pay on that balance over the next 10 years. Again, the spreadsheet only goes out to 10 years. Cell C5 then shows any remaining balance you have after 10 years. If you paid it off, then it will show $0. If you scroll down, you'll see the payments you make each month. Unless you enter an alternate payment amount, this will either be $35 if your balance is less than $1,000, since that is a fairly standard minimum amount for balances less than $1,000, or 2% of your balance if your balance is above $1,000, which is also a fairly standard minimum payment amount. You will also see how your balance changes, and if you pay it off, you will see column C, your remaining balance, hit 0. If you don't pay it off within 10 years, then the amount in cell C127 is the remaining balance that you will owe even after 10 years of payment. For example, the sample credit card information that I have entered when you first open the spreadsheet is a balance of $10,000 with an interest rate of 24%, and I have left the alternate payment amount at 0, meaning that this illustrates what happens if you only paid the minimum payment each month. And again, remember, this is also assuming you don't add any more charges to this credit card. Cell C4 shows that with these assumptions, over the next 10 years, you will pay a total of $24,000 in payments, and your remaining balance will still be $10,000, even though that was your original balance. In other words, you haven't paid down your debt at all, and the $10,000 worth of stuff you bought has cost you $24,000 so far, and will cost you at least $34,000 even if you pay the credit card off tomorrow. This shows the danger of only making the minimum payments on your credit card. Columns D and E allows you to add a second credit card because many people carry balances on multiple cards, and this allows you to put in a second balance with a different interest rate. This repeats in columns F and G, and again in H and I, and again in J and K, allowing you to input as many as 5 different credit cards with different balances and interest rates. I've used columns J and K to look at the results for one particular purchase, say a new phone for $1,000, instead of an individual credit card. You can choose to use it either way. Note that of the 5 samples I've included on the default spreadsheet, only the last 2 actually get paid off within 10 years, and all of them end up with you paying significantly more than the purchase price of the items you've bought. That's not great. As you can hopefully see, if you carry a balance on your credit cards, you're going to be paying an exorbitant amount of interest on your purchases if you only make the minimum payments. And even if you put in an alternative, higher payment amount, you will still pay a ton of interest if you do not pay off your balance in full each month. If you are taking notes throughout this series, take a screenshot of your spreadsheet and paste it into your notes, as well as a link to your copy of the spreadsheet for future reference. Then write a paragraph or 2 reflection on this exercise. Is this going to change your behavior in terms of your use of credit cards and how you pay them off? If you're comfortable sharing your reflection, there are several ways to do that. If you're watching or listening to this on Spotify or YouTube, then you can leave your thoughts and/or your feedback or questions in the comments. You can also always reach out to me directly on social media or via email. I'm Carl Fish on Blue Sky, Twitter, Facebook, and YouTube, or you can email me directly at carlfish@gmail.com. This exercise demonstrates the danger of using credit cards as loans if you don't pay them off in full each month. But this raises the question, what do I do now if I'm already carrying balances? Well, obviously, the answer is to pay them off as quickly as possible, but it's important how you pay them off. There's a popular method called the snowball method, which suggests you pay off the lower balance credit cards first to get some momentum and encouragement to continue paying them off. If that's really, truly the only way you think you can do this, then fine. But it's definitely not the best way to do this. Interest rate matters. I've linked to a blog post on the slides that goes into this more in depth. The best way to pay off credit card debt, and really any debt, is to always make the minimum payment on each balance because you don't want to pay late charges or impact your credit score. But then with any additional money you have each month, always devote all of that to the highest interest rate debt you have. Once you've paid off the highest interest rate debt, then shift to the next highest, while still always making the minimum payment on all balances. Continue doing that until all of your debt is paid off, and then don't get into that situation again. This will result in the lowest amount of interest being paid and in paying off your debt the quickest. There is one more topic that often comes up, which is, should I pay extra on my mortgage? The answer, as it so frequently is it depends. To be clear, it's not a bad decision to pay extra on your mortgage if you've chosen to do so, but it is often not the best decision. Key factor is the interest rate on your mortgage. In general, if you think you can earn a higher rate of return by investing the money than you can by paying extra on your mortgage, it makes sense to invest any extra instead of paying extra on the mortgage. A good guideline is that if your mortgage rate is less than 4%, invest any extra money instead of paying extra on the mortgage. This is because historically, you could have invested the money and earned between 7% and 10% on the money, which is obviously more than 4%, so you come out ahead. If, however, your interest rate on your mortgage is 6% or higher, it likely makes sense to devote much, or all, of any extra to paying off the mortgage. This is because if you have a high rate on your mortgage, then paying on a 6% mortgage is getting a guaranteed return of 6%. While you might earn more than that in the market, it's not guaranteed. And if your rate is higher than 6%, it makes even more sense to do so. So what if it's between 4% and 6%? Well, that's more of a judgment call based on a combination of your risk tolerance, the expected forward returns of the market, and the rest of your financial situation. Either choice, paying extra or investing, is likely to be a good one. The same question about paying extra sometimes arises around student loans, and the same guidelines around interest rate applies here as well. But there's also one additional caveat, which is if you are enrolled in an income-based repayment plan and/or public service loan forgiveness. As of this recording, student loans are very much in flux, so it's hard to know what these programs will look like going forward. But the way they are structured now, it often makes sense not to pay extra on your student loans. If you are in an income-based repayment program, and if your income is fairly low, then you may make very low payments for 20 to 25 years and then your balance is forgiven. If you also qualify for public service loan forgiveness, then your forgiveness happens after only 10 years. There are a variety of strategies to keep your AGI low in order to lower your student loan payments, including contributing to FSAs or HSAs, as we talked about in episode 6, or contributing more to your pre-tax IRA, 401k, 403b, or 457b. Often it can make sense to devote any extra to those things as they provide tax advantages and or let you save for retirement, while at the same time lowering your current student loan payments. This results in you paying much less in total until you reach loan forgiveness. As always, your individual circumstances matter, so you'll want to do a little math. Hopefully, this episode has given you some new things to think about in terms of debt and how you may be able to sometimes use it strategically, but for the most part, you should try to avoid it whenever possible. If you're in a hole, stop digging and do everything possible to get yourself back to ground level, and then don't dig any additional holes. In our next episode, we'll talk a bit more about credit cards and how, if used them responsibly, instead of them being an existential threat to your financial stability, they can actually be a force for good.